Look at this setup. It looks perfect, but still failed. Here is why most smart money concept traders lose, and you will learn the rules that work. Let me show you why this fell. But before that, hit the like button and subscribe to this channel. Most smart money concept setups fail because of these reasons. 1. No higher time frame bias, no liquidity sweep, wrong zone, and no displacement. So what actually works? These are the simple rules we will follow to get a high probability SMC setup. Number 1. Higher time frame bias first. 2. Wait for liquidity to be taken. 3. Wait for displacement and structure shift. And 4. Only trade correct zones. Let's apply these rules on the chart. We have a confirmed market structure making higher high, higher low. Here is inducement, and here is order block. You must have heard many smart money concept traders make a statement that POI closest to inducement is usually a high probability POI. They just say it out of context. If you just go ahead to treat POI closer to inducement as a high probability POI without putting other confluences, you are going to have series of failed trades. And that is exactly what I'm going to explain here. We pick this setup and analyze why it failed. So let's look at it. This is AUD USD and 1 hour time frame. We are going to look at the higher time frame because that's the first rule. Let's switch to daily time frame. This is our daily time frame, and as you can clearly see here, we have order block, which is the extreme order block in this structural move, and this is a bullish market. Price has mitigated the extreme order block, and clearly we are in uptrend, so we can take any long position. Let's go back to 1 hour again. And from here, normal SMC concepts, once liquidity is taken, we look for entry, but we are not predicting how the market will move. Our target here is to react. So after market had taken out this inducement, it reached this order block, broke through it. Why did it fail? Let's zoom to 5 minutes time frame, which will be our entry time frame. If you are using 4 hours, 15 minutes time frame should be your entry time frame. Then if you are using daily time frame, 1 hour should be your entry time frame. If you are using 15 minutes, 1 minute should be your entry time frame. So this is 1 hour that we are using for structure. We used 1 day for direction and 1 hour for the structure. So our entry time frame is now 5 minutes time frame. Let's go back to 5 minutes time frame and look at how it is here. Zoom out, please. From here, you can see clearly that when price got to this POI, there was no market structure shift. That's why this trade failed. So if you have a POI you are targeting, price gets to the POI without market structure shift, don't execute the trade, else you are likely going to fail. Let's go back to 1 hour time frame and take other examples. Some SMC traders can also see this as a short opportunity if they fail to consider the direction of the market, which is the higher time frame bias. As you can see here, this is a valid fair value gap, and here is liquidity. Let's mark it together. Here is liquidity, and a normal SMC trader who doesn't consider the market direction would like to short here, put a short position too here, and place order. This order and the stop loss will be placed above this. So any SMC trader who does not consider the market direction is a market donor. Are you a donor, a collector? If you want to be a market collector, make sure you pay attention to this and watch this video to the end. If a trader who doesn't put market direction into context places a short trade on this fair value gap, you can see clearly that market got to the fair value gap and traded above the stop loss and continued the market trend, because market is on bullish trend. So always consider the market direction and what the higher time frame is saying, not just trading any order block or fair value gap you see on the chart. Else, you will be a donor and not a collector. And which one do you want to be? Let me know in the comment section. Let's take another example. Here we have break of structure. Let's mark the break of structure. There's confirmed break of structure here. And after break of structure, we can look for buy position since this is a bullish market. So inducement has been taken here. After market took the inducement, it got to this mitigation block. From here, we switch to lower time frame, which is 5 minutes, because we are using 1 hour to mark the structure here. So we go down to 5 minutes time frame and look for market structure shift. So let's do it together. And here is it. Let's zoom for you to see it clearly. Okay. Price got to this point. There is market structure shift here. And after market structure shift, we look for inducement. Inducement has been created here. Here is inducement and order liquidity. So, and we have our order block. Here is the order block here. So from this order block, we can place a limit order. We can place a limit buy order here. Put the stop loss slightly below the low of the lowest candle and target the swing high of the higher time frame, which is 1 hour here, and target swing high here. As you can see clearly, this is a winning trade because we followed our rules. The first example failed because there was no market structure shift and displacement before entry. But in this particular example, there is market structure shift and displacement before we executed our trade. Before you trade, make sure you follow the rules I stated earlier. Let me recap the rule. Number 1, higher time frame bias first. Wait for liquidity to be taken. Wait for displacement and structure shift. Then only trade correct zone. Smart money concepts don't fail. Traders fail by using them wrongly. See you in the next video.